Hi all, sorry for the technical difficulties. Thank you for joining us today for the Locum Tenens tax webinar. My name is Greg Boughton, the Demand Generation Manager here at Barton Associates. With me is Ellen Lowry, our Content Marketing Specialist, and we'll be moderating today's webinar. Joining us today is Andrew Schwartz, a CPA who has specialized in helping healthcare professionals with their accounting, tax, and payroll needs since 1993. At the end of today's webinar, we'll have some time for a questions and answers session. Those of you who completed our pre-webinar survey had the opportunity to submit questions in advance, and we'll go through some of those first. If time permits, we'll take more questions submitted during the webinar, so please ask any questions in the chat box on your screen. With that, I'll hand this over to Andrew. Thanks again for joining us.
Thanks, Jeff. As Jeff said, my name is Andrew Schwartz. I'm a CPA here based in Woburn, Massachusetts. Each winter, my firm prepares about 2,000 personal tax returns mostly for physicians, dentists, and psychologists. And the rest of the year, we work with small practice owners. So we're very familiar with the tax issues affecting you and your colleagues. So let's go over some of those issues right now, and hopefully I can help you shed some light on how to save some taxes. Okay, one second. Great. So today we're going to first talk about some basic considerations for independent contractors. Then we're going to touch base on some of the deductions that are common to you and your colleagues. And don't worry, I'm not going to read all the slides, but I'm just going to go through what we're going to go over today. We will talk about retirement accounts. This is a great way to cover yourself for your family's health insurance needs and build up a nice nest egg for the future with health savings accounts. As an independent contractor, you most likely need to pay your own taxes. We'll talk about how to do that. And then we'll go over some planning tips and talk about what's new in 2018 and 2019 with the new tax laws that went into effect on January 1st, 2018. And we'll hit on the new QBI deduction, which a lot of people want to learn more about. And on one hand, it's overly complicated, but a lot of it isn't that tough to figure out. Okay, so let's start by talking about deductions. One of the best ways to save taxes is to deduct expenses against your locum's income. And so for a business expense to be deductible against your locum's income, it needs to be both ordinary and necessary in connection with your profession. There's a whole list of things that are ordinary or necessary, but basically it's any time that you incur an expense because you're a physician working in the field of medicine or whatever type healthcare provider you are working in medicine that I wouldn't incur because I'm not in the field of medicine. That usually is what is ordinary and necessary. There's a whole list of expenses that you can deduct. It's pretty common sense. It's your licensing, your dues, travel in connection with your jobs, car expenses, home offices. There's a whole list of expenses. We're going to go over a lot of them now, and we're going to touch specifically on health insurance, your travel, lodge, and meals, your automobile expenses, and your education, licenses, and examinations. Let's start out by talking about health insurance. So a lot of people, when somebody works for a company, they get the health insurance still usually through their employer. Okay, so it's nice and easy when people work for somebody because the health insurance is provided through their employer. When you have a situation where you're basically self-employed and you have your own small business, you really need to get your own health insurance to cover the insurance needs, the health needs for you and your family. And the rules are very simple. Basically, if you're self-employed or you have your own little S corporation or something like that, and neither you nor your spouse is covered under a health insurance plan through another employer, then under the current rules, 100% of the health insurance premiums that you pay are tax deductible. And they're not deductible as a medical expense, as an itemized deduction. They're deductible on page 1 of your tax return as an adjustment to income. So just to repeat myself, 100% of your health insurance premiums that you pay for your family, for you and your family and your dependents, is fully deductible when you're self-employed. Now, if your spouse has health insurance, you are out of luck. You're not able to deduct the health insurance premiums that you pay. And that even applies if your spouse has access to insurance and opts not to take it. But there are a few things that I do want to point out with health insurance. First of all, if anyone is 65 years old or older and are getting Medicare through the federal government, the Medicare premiums that you pay count as self-employed health insurance. Even if you're getting Social Security, if you're collecting Social Security, and they're taking the Medicare premiums out of your Social Security compensation, out of your Social Security benefit, those Medicare premiums count as self-employed health insurance. If you have decided to treat your small business as an S corporation, so instead of being a sole proprietor, you either set up a professional corporation, a PC, or you had an LLC and you made an election to treat that LLC as an S corporation, you can still deduct 100% of your health insurance premiums. You are supposed to have the S corporation or your practice pay 100% of your premiums, and you're supposed to reflect those premiums paid on your W-2, but then you get to deduct them as on page 1 of your tax return as well. So your practice deducts the health insurance. The S corporation will deduct the health insurance premiums that are paid. You pick it up as income on your W-2, and then you deduct it again on your tax return. So it is ultimately tax deductible. But as someone who's self-employed, make sure that if you're paying health insurance, that's a deduction that you claim. Okay. Another big deduction has to do with travel, lodging, and meals. One of the benefits of being in the profession and working for a company like Barton Associates is you get to travel all over the country, and I guess probably the world, I would assume. And you get to go to all different places. While you're there, you do get to work and help people in that area, but you have the opportunity to experience different parts of the country, and that's all very interesting. As a sideline, you also get to deduct the cost of any unreimbursed travel, lodging, and meals that you incur while you're on your assignment. So for your any travel expenses and any lodging expenses, that deduction is always based on the actual expenses incurred. So somehow you need to keep track of that, and we'll talk about that a little bit later. Your meals, the government actually made things a little bit easier here, where they set up these things called per diem rates. And with per diem rates, you get to deduct the cost of the meals based on the daily allowance. Let's see if this is going to work here. That's good. So you get to deduct the cost of the meals based on the standard allowance. And let's see, here's the GSA website, and then there's a per diem lookup. And we are going to use the old lookup because it's more interesting. And so basically, it's just a map of the country. And if you're in Massachusetts, or if you're traveling to Massachusetts, it will show down below the daily rate for the food and meals and incidentals while you're traveling. So when you travel for work, you have the option based on each trip. So it's not an annual election, it's per trip. With each trip, you can decide whether you want to base your deduction on actual expenses incurred for your meals and incidentals, or on the per diem rate, where if you say you came to Boston, it's $71 a day. I find that when I do people's tax returns, most people don't keep such diligent records, and they will deduct their meals based on the daily allowance. So this means if you go and you take a 2-month assignment in a different city, a city outside of the general vicinity of where you live, if you take an assignment where you have to travel to get to, you're allowed to claim a daily rate for every day that you're there for the meals that you incurred. Now, keep in mind, meals are only half deductible, but nevertheless, if you're somewhere for 30 days, if you go to Boston for 30 days, you're going to get a $2,100 tax deduction, of which half is tax deductible. All right, so and if you travel internationally, this website, I was told, is no longer accurate, but you can find foreign per diem rates as well. Just repeat myself, the deduction for your meals has to be consistent per trip. So you can do some on actual expenses. So say you go somewhere and you really splurge on food, you do actual expenses there, and then another place you're a little bit more frugal, you can do your per diem rates. The business trip, to be able to deduct your travel, your meals, and your lodging, the trip has to be for a period of a year or less. The intent of you going has to be for a year or less, and you have to intend to return back to where you were living before the trip started. If not, you become a migrant worker. That's the terminology in the IRS. So if you go away and you take an assignment and it's going to last less than a year and you're going to come back home after the assignment, you get to deduct your travel, your meals, and your lodging. Once you're there, the day that trip, the end date becomes either uncertain or it's going to be more than a year after you started the assignment. The day that happened is the day you no longer get to deduct the meals, travel, in the lodging. Okay, and as I said, for this to qualify, the trip has to be outside the general vicinity of where you live, which means you have to go far enough away that it wouldn't be possible for you to return back home without resting first. So you got to drive far or fly, and you can't come back in the same day without sleeping before coming home. Okay, so that's with travel, meal, and lodging. And for the Locum Tenens community, that is a huge deduction. Even if you get reimbursed for your lodging and your travel, the meals are still a great deduction. Okay, automobile expenses. Automobile expenses are deductible if any of these three qualifications are met. It's either miles for driving between job sites, you drove between your home and a temporary job site. In the temporary job site, it's the same rule where the assignment needs to be for a year or less. And once the assignment is going to become indefinite or last for more than a year, it's no longer a temporary job assignment as of the date that happens. And traveling to job interviews, conferences, things like that. When you want to deduct your automobile expenses, there's two ways that you can claim the deduction. The first way is based on the standard mileage rate. And for 2018, that was 54.5 cents per mile. So basically, you figure out how many business miles you drove during the year. You multiply that by 54.5 cents per mile, and then that's your deduction. The other way you can claim your deduction is on actual costs incurred. And by doing that, you add up the cost of your gas, your insurance, your repairs. Your parking at home is an automobile expense, and your lease payments, if you lease your car, are a factor for depreciation if you own your car. And what you do is you figure out the total miles you drove during the year, and that's the denominator, and the business miles is the numerator, and that's the percentage of those expenses that you can deduct. What I've seen over the years is unless you drive very few miles during the year, and most of those miles are business miles, in the long run, you end up being better off claiming your deduction on the standard mileage rates and not on the actual costs incurred. But let's say they live in the city, they're paying for parking, they have to pay to park their car, they only drive like 3,000 miles during the year, of which 2,400 is business miles. Well, then you're talking about taking 80% of all these expenses, including parking costs, and then the actual expense method would probably work out better. I'd like to add, there is a new rule about these SUVs with a gross vehicle weight over 6,000 pounds. So if you want to drive one of those big vehicles, you basically can deduct the business use percentage of the total cost of the car this year. So if you spend $80,000 on a big SUV and you drive your car 75% for business, believe it or not, you can take a $60,000 tax deduction all in 1 year. You do need to keep the car in business use over 50% for 5 years. If not, some of that deduction comes back into income. But it's a huge, huge opportunity now. And we get this question a lot, whether people should lease or own their cars. If you have your own business and you're going to provide yourself with a car, leasing is actually easier because you pay the lease and then you write it off as you pay the lease payment, and it's just easier to keep track of everything. But the real answer to that question is a question, and that question is, how long do you want to keep your car? How often do you want to get yourself a new car is what the question is. If you want to get a new car every 3 or 4 years, then you should just lease. You just lease the car every 3 or 4 years, you turn it in, you get yourself a new car, and leasing's easier. If you're frugal and you want to keep a car 7, 8, 9 years or more like I want to do, I buy, and financially I find that it's a little bit better off to buy a car and keep it for a number of years. But some people love getting a new car every 3 or 4 years, which is fine, and leasing works perfectly for someone in that situation. Okay, and then let's talk about education, licenses, and examinations. So this is another big cost. And these expenses are all tax deductible. So the rule is simple. anytime that you incur cost in connection with a program that qualifies you for a new trade or business, medical school, PA school, nursing school, all that stuff, that all qualifies you for a new trade or business, none of those costs are deductible. And in theory, your initial licensing, which allows you to practice in your profession, isn't deductible either. But after that, it's all deductible. If you're going to get licenses in multiple states, all the fees in connection with getting the licenses is deductible. If you need to re-up your license every 10 years or whatever the rule is, and you need to take a review course to do so, and you have to fly somewhere to take the test, all that stuff is tax deductible because you've already established yourself in your current profession. So this is just to maintain your skills in your current profession. And education is kind of interesting because there are things that are deductible. So if you're working as locum tenens and you're in the field of medicine and you want to increase your knowledge in the field by maybe getting an MHA, there's some financial designations that healthcare people can get now to teach them about the finances of healthcare and all that stuff. I would say all of those costs would be tax deductible against your income. So even if you pay $30,000 or $40,000 for tuition for a course, if you have enough income, I would suggest that would be tax deductible. And it's great. So you want to keep track of it, but pretty much anybody who works in a lot of states, I don't know if you would typically be reimbursed for the licensing fees or not. But if you're not, you want to make sure to deduct that against your income. So these deductions are very important because one of the goals of pretty much everybody is to minimize their taxes. If you work as a self-employed individual, the taxes can feel quite onerous, right? So you earn your income and then you deduct your expenses against it. When you earn this income, you're going to pay, if you don't have an S corporation set up, you're going to pay federal taxes on the income you earn. You're going to pay state taxes on the income you earn. And then when you work for somebody as an employee, that company will withhold Social Security and Medicare taxes from your salary at 7.65%. And then that company matches those taxes. So the government gets 15.3 cents for every dollar of salary that you earn. When you're self-employed, in addition to the federal and state income taxes that you're going to pay on your income, you also pay this 15.3%. It's called self-employment tax as part of your federal tax return. So even if you're in a relatively low federal tax bracket, let's say you're in the 25% federal tax bracket, which I don't even think there's a 25% bracket anymore, but let's just say 25% federal taxes, you live in a state where there's a 5% tax, and then your self-employment tax is another 15%, your marginal tax rate is over 40%. So each additional dollar you earn, you send 40% of that over to the government, or each additional dollar of expenses that you come up with to offset that income will save you 40% in taxes. So when you're self-employed, understanding what's deductible and coming up with a system to keep track of those expenses is very important. Okay, so now let's just talk about retirement accounts. So I'm not going to dig too deep into this. There's some options there, and there's some options that make sense for a lot of people. But it's very important if you're self-employed to consider not whether or not to contribute to a retirement plan, but which retirement plan makes the most sense for you in the current situation. So let's just talk about why saving for retirement is one of the best tax shelters available to working people. And let's again say that you're here in this example, you're in the 28% federal tax bracket and the 5% state tax bracket. So if you're in those tax brackets, each additional dollar that you earn is going to be taxed at 33%. So any deduction you have will save you taxes at that rate. So let's say that you can only afford to put $1,000 away into a retirement account this year. So when you put away the $1,000, you're going to save $330 in federal and state income taxes. So 1,000 minus 330 is $670. It only costs you $670 to have $1,000 in your retirement account growing tax deferred. You already earned $330 on your $670 investment, so you already earned a 44.25% return on your money. Now that's great, and especially in a volatile market right now. You've earned 44.25%. Yes, you are going to pay taxes when you take money out of your retirement account down the road. Okay, so you don't earn the 44.25% and keep it. What you do keep is the compounded earnings on the government's money for as long as that money stays invested. So this first year, you put in $670. The government put in $330 because they didn't get those taxes because you put the money into the retirement plan. You keep the compounded earnings up to $330. Next year, so the first year you'll earn whatever, maybe $30 on the $330. The next year you earn $35 on the $360, and then it grows from there and there. And you can put away much more than $1,000 per year. The limit for 2019 for someone who's under the age of 50 is $56,000. And if somebody's 50 or older with a solo 401k, they can put away $61,000 depending on their income. So we're talking about the government giving you a third of that money and letting you invest that money and keep the compounded earnings for decades and decades. That's the beauty of putting away money for retirement. And the period of time that money compounds, it's not just during your lifetime. So the way the rules work is you put away money. When you pass away, your spouse will take over the money. It doesn't get taxed at that point. And then when your spouse dies, assuming you predecease your spouse, it goes to your kids, and they spread that money, your retirement money, over their lifetimes. So there's decades and decades and decades of tax-deferred growth, and that's the power of all these retirement accounts. It's not save taxes today, pay the same taxes later. It's saving taxes and then building up this nest egg at a much higher rate because there's no income taxes involved. The three choices that people have basically are these things called SEP IRAs, SEPs. That's a small employer pension, SEP. Simple IRAs, those came out during the Clinton years. Simple IRAs, and then there's solo 401ks. And they all have different rules and everything. But basically, with a SEP IRA, you can put away 20% of your net self-employment earnings. So if you earn $100,000, you can put away 20, and that'll save you taxes. The simple IRA this year, if you're under 50, you can put away $13,000 plus 3% of your income. So if you make $100,000, you can put away $16,000. In the solo 401k this year, if you're under 50, you can put away $19,000 plus 20% of your self-employment earnings. So if you make $100,000, you can put away $39,000 into a solo 401k. For 2018, if you haven't set up a retirement plan, your only option is a SEP IRA. You have until April 15th, or you have until the due date of your tax return, including extensions, to set up and fund a SEP for last year. Otherwise, a solo 401k needs to be set up by December 31st of the year you want to put money away, and a simple needs to be set up by October 1st. So this stuff, it's not that it's that complicated, but there's very specific rules that go along with retirement plans. So if you use a financial advisor, they can help you. Fidelity, Vanguard, and Schwab all have retirement departments who could answer these questions for you and make it easy for you. So, but as I said, the question isn't whether or not you're going to set one up. The question is how much you're going to contribute. All right, so now let's talk about health savings accounts. So first, I just want to touch on what insurance is. I'm not going to go into what health insurance is, but insurance was set up a long, long time ago to protect people against a financial catastrophe. Okay, it's to protect against a catastrophic. But health insurance, after World War II, I believe, it evolved to the system where the health insurance system paid everybody's bills as they went along. And they did that thinking that they would rather, it's more important for people to have their preventative care than to not go to the doctor and have this huge thing manifest itself that could have been avoided if they just did some preventative care. I think that's my theory anyways. But we're all more educated now, and health insurance is becoming more and more expensive. So people who earn a decent living, they're looking for health insurance to protect them against a catastrophic. They're not looking for health insurance to pay all their bills. So they're switching over and going, many are going to a high deductible health insurance plan. So if you go to a high deductible health insurance plan, there's this special account that you can set up called a health savings account, an HSA. And these came out during the Bush years, if anybody's a financial historian. So so what happens is they set up these things that are just great savings opportunity for people who have a high deductible health insurance. Basically, what happens is when you have a high deductible health insurance plan, your medical premiums go down, and then you can set up this health savings account if you have a qualifying high deductible health insurance plan. And whoever you get your health insurance can tell you this. And first, you can make contributions into the HSA every year, and the money you put into the HSA is tax deductible. For 2018, you can put away $6,900 if you have a family plan, or if it's you and a dependent, or you can put away $3,450 if you are a single individual plan. It went up a little bit in 2019 to $7,000 and $3,500. Okay, so you have a high deductible health insurance plan that qualifies for a HSA. The money that goes in is tax deductible. The money while it's in the HSA grows tax deferred. Any money that you take out from the HSA to pay your family's medical expenses and dental expenses and things like that comes out tax free. And any money that's in the account when you turn 65, you can take out. You do owe income taxes on the money you take out, but there's no penalty. There's no 10 or 20% penalty for taking out money early. So it's a huge tax savings opportunity, these health savings accounts. And it's definitely worth exploring if you're getting your own health insurance and you and your family are reasonably healthy and you can afford to pay a little bit higher copays and deductibles and things like that. One of the strategies that a lot of my clients, a lot of people who can afford to do so is they take advantage of these health savings accounts. They contribute money into the account each year. And then when the family has medical expenses, they do not take money out of the health savings account. They'll take the money out of their checking account, and they'll have a larger amount of money growing within the health savings account to use later. Now, believe me, as you get older, you're going to have the need to have money to pay for your health insurance. So building up a nest egg for money earmarked for your health insurance later in life, for your health costs later in life, is a pretty great thing. A pretty great thing to do. If you're going to take advantage of a health savings account and keep the money invested, you're not going to want to just keep it in the bank most likely and earn very little interest. So through some financial institutions now, you can invest your health savings account in Vanguard funds and in other places and get the growth that the stock market generally provides as long as the money stays invested over a period of time. Right, but I have clients who have tens of thousands of dollars in their health savings accounts now, and it just gives them a little bit of peace of mind. Okay, estimated taxes. So why would you pay estimated taxes? Because if you don't pay estimated taxes, the government first charges you a little bit of a penalty, and also it's harder to come up with the money for a lot of people later if you owe a big chunk. If you paid it over, if you're paying your taxes throughout the year, then it's just easier. It's easier to budget and all that stuff. Okay, so it's easy to do. Whoever does your tax return, if you do your own tax return, it'll generate these estimated tax vouchers. You can also you can pay it online, irs.gov. They make it very easy to pay your estimated taxes online. Every state, I'm sure, has some online filing. I know Massachusetts does. The IRS has an app called IRS To Go that you can use your phone to pay your taxes. They'll take the money out of your bank account. But you do it because if you don't pay the estimates and you don't have enough taxes paid in during the year, you should expect to be assessed a underpayment penalty. And then you have to scramble to come up with the money, and then you have to come up with your first quarter estimates. So paying quarterly estimates is the way to go. If you did set up an S corp for your locums work, then you'll be paying yourself salary through that entity, and you'll be withholding taxes throughout the year. So that's one way to avoid estimates. But paying estimated taxes is no big deal. They make it very easy for you to pay in the money. Usually most people base how much they're going to pay in quarterly estimates on their prior year's tax. But if they but if your income fluctuates and it's going to be higher or lower, then you would adjust your estimates accordingly. And if you do your own taxes, you just plug the numbers into the software. It'll kick out what you need to pay in. All right, so let's talk about some planning tips. All right, so first of all, in my office, we tell people who are self-employed about the 40% rule. And basically, we say it's a good idea to set aside 40% of what you earn for taxes. Remember, you're going to owe federal taxes, state taxes, and self-employment taxes on the income that you earn after deducting whatever expenses you're going to deduct. The retirement plan and the HSAs will reduce your federal and state taxes, but not your self-employment taxes. But it is a great thing to do. We do recommend that people submit their quarterly estimates, like I just talked about. We do recommend that you come up with a system to keep track of your expenses. Remember at the beginning I said that the marginal tax rate's like 40-45% for each dollar you earn, or each dollar of expenses that you can come up with. So it's too expensive not to come up with a system to keep track of your expenses. So we would recommend the best thing to do is use a program like Quicken or Mint. Mint is a free version of Quicken that you can get online. It downloads all your bank information and your credit card information, and then it can generate a report at the end of the year. So that's mint.com. Another suggestion is to use a credit card only for your professional related expenses. Hopefully a credit card that gives you a summary at the end of the year. Be diligent about only putting business expenses through there and putting all your business expenses through there, and you'll get a nice report at the end of the year showing you what to deduct. There's an Excel spreadsheet. Let's see what this thing looks like that you could use. And here it is. Oh, it's on my site, I guess. Let's see. And or some people they'll throw receipts in an envelope and tally it up at the end of the year. That's the least best way to do it. But come up with a system, stick with it, and it'll save you taxes. It's tough to remember once a year the money you spent, when you spent it, and all that. If this comes up, I'll let you know. Okay, but keep track of your professional expenses. Keep good records. Same thing. If you do get audited, the government's going to want you to provide two things. One is proof that you made the payment. So they're going to want to see a canceled check or a credit card receipt. Or actually, a credit card statement that shows the payment. But they're also going to want to see a receipt because they're going to want to know what you bought with the money, especially if it's something that could be personal or might be business. So record keeping, two components: proof of payment and the receipt showing what was purchased. And take advantage of tax shelters. Tax shelters is not exactly the right word, but there are ways to shelter your income. And retirement plans and HSAs, as we talked about, are both great ways to do that. And it's same thing. I would figure out what you can put away during the year, and every month put some money away. It's so much easier to consistently put away money than to try to scramble at the end of the year and come up with money to do all these things, including paying your taxes and all that. We didn't write this one down, but I do want to touch briefly on how state taxes work because you guys work in a lot of different states. With state taxes, you are first taxed in the state where you work, assuming there's an income tax. Okay? So you live in one state, you work in another state, you first pay taxes to the state where you work. You then figure out the tax on the state where you live on that income you worked in the other state, and you take a credit for those taxes paid to the other state to offset your tax to your resident state, okay? So taxes where you work, you figure out the taxes where you live, and then you reduce the taxes where you live based on the taxes where you worked, all right? How's that? Okay, so essentially, when you boil it down, if the state you work in if that tax is higher than the state where you live, then the tax rate you pay is based on the state where you work. If the state where you live has higher taxes than the state where you work, then ultimately you pay taxes to the state where you work, and you pay the difference to the state where you live. So you pay the higher tax rate based on where you live. Okay, so you are going to pay the highest rate between the two states. It just depends on who's going to get the money. And lastly, consult a tax professional. Yeah, the rules are complicated. And I don't know how people who do one tax return a year can feel confident that they've done a good job on it. I know when we have entry-level accountants, it takes them 2 or 3 years to really get a sense of the rules and everything that's going on. But if you use TurboTax and you diligently go through all their questions, I'm sure you can come out with a pretty good result as well. But as a CPA, I recommend working with a CPA. And lastly, I think, where is this thing? Okay, the new QBI deduction. So this is the new rule that they put in place for January 1st. So Trump's goal was to reduce the corporate tax rate, and he wanted to reduce it from whatever was at down to 21%. But to do so, he had to put something equitable into the tax rules for people who are self-employed and people who have flow-through entities such as S corporations. And there's this new 20% tax deduction. So if your income is low enough, you're self-employed, and let's say you're married and together you and your spouse, your income is below, your taxable income before the QBI deduction is below $315,000, you get a deduction equal to 20% of your self-employment income. So again, let's say you make $100,000 after expenses doing your locums, you and your spouse, your income is below $315,000, your taxable income, you're going to get this additional $20,000 tax deduction on your tax return, the QBI deduction. If you're single, it begins phase. Now, there's a mistake. It's supposed to be $157,500. Sorry about that. If your income is below $157,500 and you're filing as a single individual, you qualify for the full 20% deduction on your self-employment income. If your income is higher than $415,000, your taxable income, if you're filing a joint return, or higher than half of that, $207,500, if you're filing as a single individual or unmarried, if you're filing on your own, then because we're in a specified service, trade, and business, which medicine is one of them, you will not qualify for any of the QBI deduction. And if your income falls between $315,000 and $415,000 if you're married, or $157,500 and $207,500 if you're single, then you get a partial QBI deduction. But someone who's below that threshold, to get this 20% deduction, and then you factor in the lower tax rates under the new rules, we're seeing that people in that range who are self-employed are seeing their taxes go down by quite a bit this year. So hopefully you'll find the same thing. And if you do, you can use the tax savings to put away more money into your retirement accounts and your HSAs. Okay, so I think that's everything that I wanted to get through, and I think Jeff is now going to forward some questions or read some questions.
Thanks, Andrew. We are receiving a lot of questions about filing as a individual versus an S corp versus an LLC. Can you I know you touched upon that a little bit, but go a little bit more in detail with that? Sure.
All right. So originally, back in the old days, there was two options. You were either a sole proprietor or you were a corporation. And things evolved over time where there's now LLCs and there's S corporations. So a sole proprietor is when you just basically hang a shingle and you start working and they pay you to work as a independent contractor and you deduct expenses against it. You're a sole proprietor. It's not a separate legal entity and it's not a separate taxable entity from your own personal tax return. Okay, so that's a sole proprietor. An LLC is actually a separate legal entity, but unless the LLC elects to be treated as an S corporation, the LLC is a disregarded entity for tax purposes. So when you get the check might be written out to so-and-so MD LLC because it's a separate legal entity. It does exist, but when it comes time to do your taxes, you do your taxes the same way as if you were a sole proprietor. An S corporation is a separate legal entity and it's a separate taxing entity. So the S corporation, the locums payments would go to the S corporation. The S corporation would pay whatever expenses there are to pay. Then the S corporation would pay the business owner a salary. It would also put money into the retirement plan for the business owner, would pay the health insurance. The S corporation would do its own tax return, and then some information from that tax return would flow through onto the owner's tax return. So it's a separate legal entity and a separate taxable entity. That's it. Sole proprietor, LLC that hasn't elected to be treated as an S corp and an S corporation. So there are some advantages to S corporations. If you make enough money, you can take out a portion of the income without paying Medicare taxes. So right now, if you're self-employed, you pay 2.9% in Medicare taxes on every dollar you earn, and then once you make more than $200,000, you start to pay 3.8% in Medicare taxes. With an S corporation, once you take reasonable salary, you can take out money and you can avoid that Medicare tax. There's also some benefits in Massachusetts with how retirement plans are deducted that are beneficial for an S corporation. And this is anecdotal, but you have a much higher chance of being audited, and the chance is still very low of being audited, but a much higher chance if you're a sole proprietor versus an S corporation. Does that answer the question?
That's great. Thank you. I know also you touched upon this a little bit, that there are a lot of questions coming up that are talking mainly about multi-state filing as well as living in a state with no income tax versus working in a state with income tax.
Okay. Again, you're going to be taxed on the higher of the two states ultimately. So if you live in a state with no income taxes and work in a state with an income tax, you're going to be taxed at that state's rate. If you live in a state with an income tax and work in a state that doesn't have an income tax, you're going to be taxed at your home state's rate. And everybody has a home state. So even, I guess, the only people who don't are transient. It's not migrant. It's transient workers who go from place to place and then there's nowhere where they call home. Their home state is wherever they're living at the current time, so they're not going to have this issue. But most people who have a driver's license, registered to vote, own a home, or have an apartment, that's their home state. So, yeah, so it shouldn't be too complicated. It's you pay taxes where you work. If there's a tax in that state, you pay taxes where you live, but you're not going to pay more taxes than what you pay to the state where you work. You know what I mean? That's not true. You pay the higher. You pay the higher of where you work or where you live.
Okay, great. Thank you. And then I think the last of the main questions is talking about a little bit more about some of the deductions around education, especially the CME, continuing medical education.
Yep.
So can you just touch upon that briefly?
Sure. So as I stated at the beginning, anytime you do anything that's ordinary and necessary in connection with your profession, that's tax deductible. And CME is something that is ordinary and necessary in connection with your profession. So most states, I think, have some type of annual or biannual CME requirement. So you can't practice if you don't fulfill the CME requirement, right? You guys must keep an eye on that, Jeff. So because it's ordinary and necessary, the cost of going to conferences and continuing education seminars are tax deductible. I know some people like to do the cruise ship ones and this and that. Those are tax deductible too. They have to meet certain guidelines, but it's available at irs.gov what those guidelines are. But traveling to go to a CME meeting is fully deductible against the self-employment income. Yeah, it's definitely a deduction. It just has to be ordinary and necessary. If you bring your spouse probably won't be able to deduct the cost of the travel. If they're not an employee of your business, which you're probably not, or if they're not a healthcare professional. But the hotel room will be deductible and the meals will be half deductible. So it's a great way to save taxes and go to some interesting places and learn some stuff too.
Great. Thank you very much. I think that actually ends a lot of the standard questions that weren't fully addressed by some of your presentations. So with that, I think we can say that this has been a very informative session with you. Just want to let everybody know, and a reminder that this is being recorded. We will be sending this out as soon as it's ready. And if you have any questions, feel free to email us at info@bartonassociates.com. On behalf of myself, Ellen, and Andrew, I would like to thank everybody for attending today, and we look forward to working with you in the future. Thank you, and goodbye.